Hi, it's Professor Mike, and we're going to be talking about completing the test in the sales and collection cycle for accounts receivable. Um, the the different assertions that we've gone over are the ways that you're going to design your test, right? You think about the different things that are important in testing accounts receivable balances, and you realize, okay, my risk in accounts receivable is really that the recorded accounts receivable exist, that they're recorded in the proper period, i.e. cutoff, and that we can actually collect them, i.e. realizable value or valuation. And then anything that is appropriately presented as related party transactions or receivables from concentration of customers or other things like that are properly disclosed. For example, the SEC requires that if a concentration of your sales or receivables is greater than 10% from an individual customer or related parties of customers, then you have to disclose that. You don't necessarily have to name the customer, but you do have to disclose that you have a concentration of credit risk. And so these are the things that you're thinking about when you're identifying what to test and what your risk is. So your allocation of your time is going to be completely based on where your risk is. Completeness of accounts receivable is usually not one of the higher risk items, and so you'll spend less time on that. That said, you do have to do procedures to address all of the different assertions for every account balance. It's just that you will do more for those that are higher risk. Um, so you think about this. It's a subset of how you plan the audit, right? You'll identify your risk. You'll set your materiality thresholds for the specific account, which is accounts receivable. Again, you have overall materiality, and then materiality for accounts receivable will be lower because if you have an error in accounts receivable and an error in inventory, and you add those up and combine their material to the financial statements, then there needs to be an adjustment. Although individually they might not hit your overall financial statement materiality level, because the two combined do, you would have an adjustment required to the financial statements for them to be fairly stated. So you have to have lower materiality thresholds for each account based on the different account balances. Then you'll address your control risk. Then you'll design your tests of controls and tests of detailed transactions in order to get information about the effectiveness of the controls and the effectiveness of transaction processing. And then you'll do your substantive procedures, which then include analytical procedures as well as tests of details. Okay? And most of the tested details in accounts receivable are going to relate to confirmations. On the sales side, they will be reviewing sales transactions, and we'll talk about that a little bit, as well as in our revenue recognition lecture. So um, you you test based on your risk assessment procedures. You do analytical procedures to determine where risk of misstatement may be in accounts receivable, and then you've got to evaluate whether there's significant risk. The presumption is there is risk in revenue recognition, which means there is risk in accounts receivable. More risk in revenue recognition than accounts receivable, but still accounts receivable falls out of revenue recognition, and therefore it is a higher risk account. Um, so your focus in accounts receivable testing and controls is really around cutoff. I am less worried about embezzlement. Um, I'm more worried about cutoff and the appropriateness of revenue recognition. So those are the two areas that you want to see your internal controls actually effectively administer, especially because, as we've talked about in this course, we're focusing on technology companies. Technology companies' revenue recognition is a big risk, and um, you're going to have, less kind of embezzlement and more revenue recognition considerations in your accounts receivable balances. And you can see here the transactions related flows and the controls are actually tied to each of these individual assertions, right? So if you think about what types of transactions you're going to be looking at, you tie them to assertions, and your test work basically reinforces their assertions. So, substantive procedures. Substantive analytical procedures, again, provide really good audit evidence. So, you can look at accounts receivable turnover. You can look at day sales outstanding. You can look at the percentage of accounts receivable write-offs that were done, percentage of adjustments, concentrations of credit among customers. All these different types of things are really, really good analytical procedures based on financial information. Then you can take non-financial information and look at things like, engagement levels if you're doing advertising, right? How much time is somebody spending on your website, and in that case, you're able to charge for ads, and what dollar amount are you able to charge for ads, and how does that dollar amount compare to the industry, right? Those are non-financial things that don't come from the records of your financial information, but they do come from other sources, which ultimately impact your financial information. So you're going to perform these procedures throughout the audit. You're going to be doing them during planning, and you're going to be doing them during your substantive test work, and you'll also be doing them at the end of the audit when you're wrapping up to make sure that sales and accounts receivable numbers make sense after you've concluded your audit work and assembled a bunch of different evidence. So you should be looking at large and unusual amounts. You should be looking at significant transactions at the end of the year. You should be looking at the flow of transactions throughout the year to see if there are unusual timing of transactions relative to prior history or relative to the normal business cycles. You're looking for affiliated companies, officers, things like that, and big credit balances, right, that are unapplied to specific accounts. So then you design and perform these analytical procedures, and if they're favorable, then you can reduce your test of balances. If they're unfavorable, then you should do more audit work. And you should always inquire of management, but you should also follow up with anything that they provide you. So you don't just inquire of management, take their explanation, document it, and move on. You need to assemble some evidence to support your analysis. So here's some examples of different analytical procedures. There's tons of them out there in software companies. You can look at annual recurring revenue. You can look at monthly recurring revenue. You can look at subscriber churn. You can look at recurring customer revenue, renewal rates of maintenance, all sorts of different things to provide you evidence about the appropriateness of revenue and also about accounts receivable. So then once you've done your analytical procedures, you are going to design your test of balances. Most of your test of balances in accounts receivable are going to be confirmations. Most of your test of balances in sales are going to be reviewing actual sales documents. if you're doing subscription or you're doing some high volume, low transaction cost items such as Netflix, such as um, Spotify, those are going to be different procedures and they're going to be subject to sampling of transactions in your control testing and your test of transactions versus large contracts, either construction contracts or large enterprise sales of product or services or large software sales. Those types of things are going to be reviewed because there are individual agreements that may or may not be standardized. And for that reason, you'll have to review those based on sampling methodology for revenue. Okay, um, textbook really doesn't talk that much about that, but that's what you face in the software world. That's what you face in the semiconductor equipment world, where you're selling large pieces of equipment or large installations of equipment to customers on a non-routine basis. If you think about going and auditing Boeing, for example, um, you know they they only sell X hundred aircraft per year, and so each aircraft sale is individually significant. And so you will go and review the aircraft sales, and and then you've got to assess whether the airlines are going to be able to pay them or not, right? So there's a lot of things to think about with respect to something like that. Uh, if you sell, you know, if you sell buses to county transit, it may be a purchase of a fleet of buses. So, excuse me, that would be a limited amount of transactions. Again, large dollar volume. So it's going to be a different approach than, like I said, Netflix, any type of subscription software that you might be using that's less than $20 a month. Um, so designing the test of details. Um, you do emphasize balance sheet accounts. You're not ignoring the income statement accounts, though, because they are a byproduct of the balance sheet account testing. And uh, the you've got to figure out, again, using your audit risk model applied to the individual account, what your level of evidence that you want the from the objective. So if you're doing accounts receivable testing and your controls are great and you've done analytical procedures, you probably don't need a lot of evidence from accounts receivable sampling, right? And so your risk assessment on detection risk at that point will probably be high, which means a small amount of procedures. This will impact your sample sizes, as we'll see in Chapter 17. Um, so what you'll get is an age trial balance of accounts receivable. Nowadays, your systems automatically or should automatically reconcile your age trial balance to your ending balance of accounts receivable. And a lot of systems will prevent you from making journal entries directly to the accounts receivable account. You would have to make an adjustment to another accounts receivable account, which would roll up into accounts receivable on the financial statements. But the subledger equaling the general ledger and then having other accounts that add up to accounts receivable on the financial statements is a clear path for you to be able to examine those other adjustments without affecting the integrity of the accounts receivable subledger agreeing to a general ledger account. The aging is going to include information about the invoice level and the day that the invoice was issued. Agings can vary slightly based on how people think about them. They could be based on the invoice date or they could be based on the due date. You need to understand when you're looking at an aging for a client how they evaluate things because an aging that's 1 to 30 days based on an invoice date is probably fine. And aging that's based on a due date of 1 to 30 means that immediately when something appears in that 1 to 30 column, it's past due. So you need to understand that context because um, the further it gets past due, the higher the risk is, and aging based on due date inherently presents a higher risk. It doesn't mean that it's wrong. It just means that you've got to pay more attention to it. Okay, so here's an example of an aging. You can see that Christopher Plumbing is over 120 days, so you'll want to spend quite a bit of time with that, as well as Brown and Phillips at 60. Um, so the tests are really to make sure that recorded accounts receivable exists, less so that existing accounts receivable are included. Okay, um, and that they're accurate and cutoff is right. Finally, that you can recover the accounts receivable, in other words, collect them, and classification is appropriate, and that they have rights to the accounts receivable. A lot of times, accounts receivable will be pledged as collateral for debt, and you need to understand that that's the situation. And there may be covenants or other compliance requirements that the client has to meet based on accounts receivable balances. Some companies actually pledge their accounts receivable, and because they need cash flow, they will essentially sell or factor their accounts receivable over to another company, which will then collect the accounts receivable and pay them. But it essentially gives the company a credit line for a month or 2 months um, while their accounts receivable are being collected. Um, that ends up costing a lot of money. It's basically like a payday loan for customers. And unless you're in a really desperate situation, you really don't want to do that. So, confirmation of accounts receivable. This is the most important test of accounts receivable. The AICPA generally requires you to confirm accounts receivable. So there's a presumption that you will confirm accounts receivable. It's not an absolute ironclad requirement, as in inventory, as we'll see, inventory observation is a requirement, but you don't want to be sitting in court defending why you didn't confirm accounts receivable. Um, and the next slide will talk about situations where you may not need to. But again, if you don't want to be trying to say, I didn't think it was necessary. You want to have very specific reasons for not confirming accounts receivable if you've made that judgment. Um, and the simple reason that the AICPA and PCAOB require it or highly recommend it is that it's third-party evidence. And as you remember from the evidence hierarchy, that's an extremely high form of evidence. And because this interrelates with revenue recognition, it's extremely valuable to get that third-party evidence because that's how you're going to find out that there's potential revenue recognition issues. So the circumstances where you can avoid confirming receivables, if the balance is immaterial, right? You know, if it's immaterial, you're not going to care, and neither will lawyers or the PCAOB. Now, what you need to make sure of is that you are doing sales testing. If the balance is immaterial at the end of the year in your audit period, but a huge volume of transactions flows through there, and you just happen to be hitting a very low point, you don't need to confirm accounts receivable, but you better be doing some really good revenue recognition testing in other spots. Okay, um, if the confirmations may be ineffective, so a couple different examples here, right? Um, if the client is in litigation with a customer, you may not, or a series of customers, you may not be able to confirm. It may actually cause challenges from a litigation standpoint for the client. So that may be a circumstance where confirmations aren't appropriate, but you would be doing substantial other procedures to assure yourself of collectability and accuracy of the receivables. That's an extreme case. You probably won't encounter it. Another one that is more frequent is things like hospital bills. Quite often, you'll be in a dispute with your insurance company over how much should be paid, and then the hospital will invoice you um, for whatever amount the insurance company doesn't reimburse. And if you're fighting with the insurance company, you're probably not going to pay your hospital bill, and you're not going to acknowledge that it's a valid bill. So the likelihood that that you as the auditor are going to get a confirmation back from a consumer who's disputing their insurance reimbursement is pretty low. And if you get it back, you might have it be an exception saying, I don't owe this money, right? In which case you've got to go back and do procedures and understand why that error, that exception took place. So that may be another place where you would not want to confirm receivables. But again, you have to defend your position. Um, the other place is when you've done so much work in every other area that confirmations, are more work than it's worth from an evidence standpoint. But again, if you don't confirm and there turns out to be an audit failure, you don't want to be defending the fact that you didn't send confirmations because you said your other procedures were adequate, and then it turned out that there was audit failure. That's just not a good fact pattern to be in. So I think the first two situations are the more likely situations where you would not do confirmations. So types of confirmations, positive and negative. Positive, I send out a confirmation. I want a response back. If I don't get a response back, I've got to do alternative procedures. Negative confirmation, don't send it back to me unless there's a problem. Negative confirmation, as you can tell, probably doesn't provide a lot of evidence on assets. And what you'll be doing is you'll be doing a lot more confirmations for negatives because they provide less reliable evidence, right? In a positive confirmation situation, if somebody ignores it, then you're going to do alternative procedures. If in a negative confirmation, if somebody ignores the confirmation, you don't know whether they're ignoring it or whether they're not responding because it's correct. And you could make the incorrect assumption. Quite often, negative confirmations are actually used for liabilities. Um, and those are, quite often, like in the case of deposits at a bank, right? A deposit is a liability to the bank. It's an asset to you, it's a liability of the bank. So the bank may send out confirmations confirming a deposit liability that are negative confirmations so that you get at least some level of assurance that the information is correct. Again, large sample size. Um, and sample sizes are based on, a number of different things, including nature, timing, extent, the inherent risk, control risk, all the different factors that you looked at in assembling your evidence go into the calculation of sample sizes. And the most reliable evidence is when they're at or near the balance sheet date. The further away they get from the balance sheet date, the less reliable they are, which means you've got to do other procedures to supplement the fact that you have done them away from the balance sheet date. However, um, doing them away from the balance sheet date is probably what you're going to have to do if you're doing a large public company, because you're not going to be able to confirm accounts receivable as of the date of the financial statements when you're releasing earnings within 25 days afterwards. Which, if you look at most of your earnings releases for big companies, that's approximately when they do their earnings release. And if you allow for, 5 to 6 days for them to close the books and give you the accounts receivable ledger, you're not going to be able to get confirmations back in that time frame. Non-responses to positive confirmations do not provide audit evidence, um, but non-responses to negatives do provide some evidence. But when you get non-responses to positives, you have to do alternative procedures. The alternative procedures are: go look at a shipping document, go look at some evidence that the customer actually ordered the goods that were shipped. Go look at the invoice, match the invoice to the shipping document to the purchase order or customer contract. Make sure that the goods were delivered, right? All these kinds of things, which, nowadays is fairly easy to do. You're going to have a FedEx or UPS tracking number or some kind of bill of lading. So these are the things that you want to understand, because, um, you could be recording an account receivable with a shipping document, with a doctored customer purchase order, shipping to, a local warehouse that is not the customer's facility. So this is why you want to go through these procedures, because the customer may look at an accounts receivable invoice for $50,000 and say, "I never ordered anything. Why do they think why do they think that I ordered something or that I owe this money?" And as a matter of policy, some companies won't respond to accounts receivable confirmations. And then, as you're not dealing with the CFO usually that's responding to accounts receivable confirmation. You're dealing with an accounts payable clerk. And so there's a real challenge in getting these confirmations executed and followed up properly. The evidence planning worksheet is a good way to think about this stuff, but you have standard audit programs that your firms are going to have, and these are very easy to follow and select procedures from a planning standpoint. You're not going to be deciding the procedures fresh out of school, but as you develop experience, you will be able to identify which procedures are going to provide you the best evidence based on the particular client and which are less relevant. And that's all part of the planning process, and then also reacting to the results that you see during the audit process. So we'll talk about sampling for accounts receivable confirmations in the next chapter.